Hi, Evan here, Investor Relations Manager at Ashcroft Capital. Today I wanted to talk about cap rates and what they are really reflecting. For reference, as many of you may already know, but if you don't, cap rate is a calculation. The longer version is capitalization rate. And to calculate it, you take your net operating income divided by your purchase price, and you get a cap rate, a percentage return. And then of course you can move that around. Purchase price times cap rate gets you your NOI. NOI divided by cap rate gets you the purchase price. Now, in many people's perceptions or many investors' perceptions, a question I commonly get is, how can you buy properties at such a low cap rate? Well, we are in a very hot real estate market, as many of us know. We're seeing it in the single family space, and for the most part, it's transferring over into apartments, and even into the commercial sector, where demand because of inflation, because of uncertainty, is driving up the demand for hard assets. Now, so what is cap rate really looking at? Cap rate has influence in multiple areas. Interest rates are a big one because, again, it is a calculation of yield. If you have interest rates at 3.5%, but you have to pay 2.5% initial yield on a property, then technically you're in reverse leverage, where there's no value to the leverage because your interest cost is more than the yield of the income. In most normalized markets, your cap rate is going to be higher than your interest rate, but not always. When you're looking at value add deals or moving up the risk spectrum, and there's an opportunity to grow cash flow, cap rates tend to have a lower and lower importance. What I mean by that is operators of these deals, and I'm going to use a development deal, a ground up development, as an example. When you buy a piece of land, that has a value to the land, and you typically need to pay at least insurance and real estate taxes on that property, even though there's no income. Or there's no revenue. So you have no revenue, you do have expenses, so you have a negative net operating income. Now, does that mean the land is worthless? No. Clearly, people are not giving away or paying others to take their land off their hands in most cases. So in that sense, a cap rate doesn't really make sense. So what does? In that case, developers are going to be looking at their all-in stabilized costs and create a discounted cash flow model. How much is it going to cost me to develop this land? Purchase price, carrying costs, construction costs, and how much am I going to get in return for that? So they are calculating a yield. They do need to know a market cap rate or take a good guess at a market cap rate to make sure that the yield that they can create, revenue once stabilized and net operating income once stabilized, divided by their all-in investment, is going to be higher than that yield is higher than their cap rate. Meaning they might be in the project $20 million, but they can sell it for $40 million because of the income stream and applying a cap rate, and therefore they can turn a profit. As you move down that risk spectrum, so from development into opportunistic, again, deals that might have negative NOI at acquisition, but a lot of future cash flow, and then you move into value add like Ashcroft does, where we're taking operating assets, but still have a significant growth trajectory in that NOI. Again, cap rates don't matter quite as much because we're really looking at the future value and the discounted cash flow type model of today the NOI might be $2 million, but next year it might be $3 million, $4 million the year following, 4.5, 5. And over 5 years, we can double that net operating income and then apply a cap rate to still turn a profit, even though the cash flow might not be, the highest today. When you're getting into core properties where there's less of a value add play, cap rates tend to historically have more significance. However, in today's market, where there's a huge supply-demand shift, and demand is greatly outpacing supply, and that's both from renters in this case, but also buyers, that cap rate is still going to be compressed. Compressed because more buyers are willing to pay more for that property and there's more competition, And it's going to have less meaning because historically, core deals where there's no forced appreciation, you're relying just on inflationary effects, that income, little by little. But in many of, particularly the major Sunbelt markets, you might be seeing 20% year-over-year rent growth at the market level. And that is more of a value add type bump in rent that you can get even without doing renovations. So they are starting to value those on the future cash flow a little bit more than current cash flow in today's market. Now, what else does cap rate reflect? The biggest one is demand. Regardless of where interest rates move, if there are a lot of people looking to buy a property and get into a space, then cap rates are going to go up. Again, because the NOI is not changing dramatically, or maybe has the future potential to change dramatically. But today the NOI is set. Your trailing 12, your trailing 3, your in-place NOI is a set number. And now you have more people willing to bid higher and take a slightly lower yield, and that's going to keep escalating. And what that really does is compress that cap rate. I hope this helps you better understand some of the dynamics of cap rate. A lot of people really focus on the cap rate and what that going in yield is. But as mentioned, there are lots of scenarios today that make that cap rate less meaningful, and it's primarily driven by that future income growth based on current market conditions. If you have any other questions, please don't hesitate to reach us at Ashcroft or at investorrelations@ashcroftcapital.com. Check out our website at ashcroftcapital.com, or you can reach me personally at evan@ashcroftcapital.com. Look forward to helping you with your investment journey.